Hello everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns, and certainly it does this past month. Yes, I haven't done a video for quite some time. I've been really busy doing actual work, which is rehabbing properties, looking at deals, moving deals, stuff like that. So actually out in the field trying to get stuff done. As I mentioned before, I see a change in the marketplace, at least where we live down here in Central Florida. A lot more deals are coming to the surface. A lot of these are off-market properties, and there's some good stuff out there if you're looking to fix and flip or buy a property for a cash flow rental, buy and hold, etc. A lot of stuff on the go here. But just before I start, this just came literally. I always check the news wire just before I start a video, and I think you could say paramount on everybody's, mind right now is the coronavirus, and the Fed slashes interest rates in response to the coronavirus. This is on from MBA, the Mortgage Bankers Association. So the Federal Reserve has announced an emergency rate cut of 0.5 percentage point in response to the economic threat posed by the coronavirus outbreak. Market watchers had predicted a rate cut in response to the outbreak, with some predicting that the Fed would cut rates before its March 17 to 18 meeting. However, today's move was the first emergency cut made by the Fed since December 2008, according to this report. And the whole idea is that, they're looking down the road saying that this virus is posing a threat to the economic activity across the country. So in light of these risks and support of achieving its maximum employment and price stability goals, the Fed Open Market Committee decided to lower the target range for the federal funds rate. So there you go. Basically, the president, of course, said that the Fed should cut rates more aggressively, and today's cut wasn't far enough, but we'll see what will happen in the near future. So that's sort of news right now, fresh, hot off the press news as of a few minutes ago. So there you go. All right, as I said, I've been busy, really busy doing real estate stuff, and it's a lot on the go here. So we're going to get to some things that I just haven't had a chance to get to. We're going to talk about CoreLogic, S&P, U.S. Case-Shiller index. We're going to talk about existing home sales and also the pending home sales as well too, that happened for the month of February. All right. So news released in the last week of February was the S&P CoreLogic Case-Shiller index, which is the U.S. home price index across the board. And like we've been seeing, prices seem to be maintaining and actually sort of eking out a little bit of increase in values across the board. So the National Home Price Index, which covers all 9 divisions, reported a 3.8% annual gain in December, which is up from 3.5% in the previous month. Now, realize that in February, they're reporting on December. Because the Case-Shiller Home Price Index is a calculation on sales pairs, it's a little more difficult for them to figure the calculation out. So it's usually a month or two lag. So we're talking in February, March about December's value. So please keep that in mind. So again, across the board on a national basis, the home price values went up to 3.8. We're up 3.8% annual gain. That's the national index. There's a 10-city composite index and a 20-city composite index. The 10-city came in at 2.4%, up from 2.0% the previous month, and the 20-city composite posted a 2.9% year-over-year gain, up from 2.5%. The cities that actually had the most annual gain were Phoenix, Charlotte, and Tampa. They had the highest year-over-year gains. We'll talk about those in a second here. So please realize that it looks like the South or Mid-South is having the most success with respect to values, either maintaining or increasing. But again, when we see everything across the board still either maintaining or increasing, the comment is it is, of course, too soon to see whether this marks an end to the deceleration or merely a pause in the longer-term trend. I always think that we should be seeing deceleration. We saw some of that already happening. With respect to rate cuts, today's rate cut, what I sort of feel is that we're going to see further increases just because, guess what? Another rate cut, if that moves towards mortgages. I spoke to my mortgage guy that I deal with all the time, and he said, hey, he's seen rates actually below 3% now on a 30-year fixed mortgage. So, this should stimulate more refinance activity, stimulate some purchase activity. And again, the reason being, well, if rates drop, the prices, don't get lower, but your purchasing power increases, which means you can maybe move up segments or buy more than you really should or feel comfortable doing because you have lower rates now. So all I think this is going to do is perpetuate sort of the lower or mid-level increases towards, at least midway to 3/4 of the year, and we'll see what happens after that. So again, still too soon to see whether deceleration will continue, but we'll go from there. Now, back, of course, the previous peak, so the Case-Shiller index was created as a method to track housing price appreciation values by two gentlemen, Mr. Case and Mr. Robert Shiller. I think Mr. Case has passed away, so Robert Shiller is kind of the Yale economist, Nobel prize-winning economist, and he maintained this. And this was done as after the first housing crisis. So the previous peak was July 2006. And then, of course, we had our trough in February 2012, and then we went back up again. So where we are from, it measures, sort of peak to trough to peak. Well, this current peak is 15.2% above the 2006 peak. So our peak was here, we troughed, and now we're 15%, a little bit more than 15% above what the value was in 2006 on a national basis. So just sort of keep that in mind as a perspective to see where things are at. If we actually look at housing, the top 20, I'll run this down right now. Atlanta had a 4.1% increase. All the top 20 had an annual year-over-year increase, all right? So Boston was 4.5, Charlotte 5.3, Chicago just 1.0, Cleveland 3.6, Dallas 2.6, Denver 3.7, Detroit 3.4, Las Vegas 2.6, Los Angeles 2.7%, Miami 3.2%, Minneapolis 3.7%, New York 1%. Phoenix was the leader at 6.5% year-over-year annual increase. Portland at 3.7%, San Diego at 4.7%, San Francisco at 2.1%, Seattle at 4.1%, Tampa at 5.2%, Washington at 3.4%. So really, your top three were Phoenix at 6.5%, Charlotte at 5.3%, and Tampa at 5.2%. Those are the strongest markets in the country with respect to year-over-year appreciation. Now, as a side note, as I said, this works on sales pairs, and they take a look at changes of value between November, October, November, December. So just as a side note, even though we had annual increase across the board in the 20 metros, 7 metros actually had month-to-month decreases. Now, these are, negative 0.1%, negative 0.2%, negative 0.7%, 0.6%, whatever that is. So they were less than a percent decrease, but there still is some slowing down with respect to price gains that are going forward. Now, where do we sit with all this? Well, the issue is, as we will always face for the next little bit, is going to be inventory. So rates are going to drop. We know they're going to continue to drop. The Fed, as I said, just cut an emergency cut of the rate. So we're going to see the probably reflection in mortgage rates, which means your buying power is increased, which means you're going to go out and buy that expensive property. So people will buy property with the low inventory. Could this create more competition? It probably could. Could this fuel more price increases? It possibly could as well too, depending on where buyers are at, depending on the mortgages they get, depending on how savvy they are, and really how much they want to pay. So even though the mortgages are attractive, do you still want to pay high prices? That's going to be up to the individual buyer itself. So that's how I see things. Now, that's Case-Shiller on values. If we go to NAR, which is National Association of Realtors, existing home sales dropped 1.3% in January. So we have lower interest rates now. We still see some price increases on the values, but guess what? The volume of sales isn't there. Why? Because we don't have the market for it. So existing home sales drop in January. Now these, of course, are closed sales, which means they were under contract most likely in November and December. We do know that the pending contract index were sort of down for those months. So, pending contracts or the pending home sales index is a look ahead, is an indicator of future sales. So if they're down, then expectations are the actual closed sales will be down as well too. So home sales did drop 1.3% in January. That's from January in comparison to December. So keep that in mind. And this is where the information is somewhat, difficult to understand, because when you look at the headline, I think, okay, home sales dropped 1.3% in January. That's compared to December sales activity. However, when I look a little deeper in the article, it says the overall sales increased substantially, up 9.6% from a year ago. So our year over year, we're actually up almost 10% in sales volume, but we were down in month over month. So it's kind of a, you got to look at things two different ways here, I guess you could say. 5.4 sales were 5.46 million, which is down month over month, up year over year. Median sales price increases up 6.8% to 266 to 300,000. Inventory dropped from 3.8 months to 3.1 months worth of inventory. That calculation is kind of a loose calculation. It basically means if all sales stopped, how long would it take on average for the sales inventory to fully deplete? That's your 3.1 months. Now, realize that some economists and NAR themselves say 6 months worth of inventory is typically a balanced market. So there's enough buyers and sellers, and the market tends to be stable at 6 months worth of inventory. So again, just keep that in mind. If we go to some detailed data here, the median, as I said, the median existing home price for all housing types was up 6.8% to 266,300. Mortgage rates have helped with affordability, but it's supply conditions that are driving the price growth, said Lawrence Yun, NAR's chief economist. Yes. Total housing inventory at the end of January totaled 1.42 million units, up 2.2% from December, but down 10.7% from 1 year ago. So clearly what happens with inventory is if you're going to sell your home and you want to list it in the month of December, a lot of real estate agents or a lot of analysts will say, don't do that. The reason being because a lot of people over the holiday season, they're not actually looking for homes or interested in buying. So you don't put it on the market, or you wait until January, and then there's your bump right there. So obviously that's why it's probably up a little bit from December. But again, we're still looking at it's almost 11% down from the previous January, which means we are really kind of hurting with respect to available inventory for purchase. Going deeper in this, the housing inventory level for January is the lowest level since 1999. So back before our current millennium, I guess you could say, not millennium. We're at the lowest level in about 20 years now, or 21 years. Look at that. And Lawrence Yun finds the outlook for 2020 home sales promising. Despite the drop in January, existing home sales are off to a strong start. The trend for housing starts is increasing, showing steady improvements, which should ultimately lead to more home sales. There you go. Regional breakdown. So the housing sales is broken into across the nation 4 regions across the country. The Northeast, which said the Northeast saw no movement, so it sort of stayed pat. Existing home sales increased 2.4% in the Midwest. Existing home sales in the South only grew 0.4% in the South, and the existing home sales in the West fell 9.4%, which is quite a drop. So there you go. So we had a little bit of, so in the end, it still was a 1.3% decrease overall with respect to home sales. So there you go. Interest rates crashing to record lows. You would imagine mortgage rate collapse would spark renewed interest, and at worst refis, and at best some more buying. There you go. Let's take a look at how some of the stuff breaks down with existing home sales statistics. And I like to sort of focus on a few things here so we know what's going on. Home sales by region. The South carried the bulk of 44% of the home sales. The Midwest, 24%. The Northeast were the lowest at 13%. The West at 19%. So clearly, things like climate and weather do make a difference with respect to who's going out to buy a home, who's looking for homes, and things like that. So that's always, as much as, I don't know how much it makes effect, but usually it's stated, if it's a warm winter, more people are out looking for property in the Northeast and the Midwest, just because, again, you're not going out during snowstorms or freezing rain or sleet with respect to, looking for houses. It doesn't make sense. So that's a scoop on there. Sales by price range. And the majority of the sales, 38%, are happening in the 100 to 250K range, which I look at being affordable housing. That's 38%. 36% are occurring between 250 and 500K. Only 10% are 0 to 100K. and then the bulk, which is, well, the remaining, which is 16% or $500,000 and above, so up into the luxury housing. So there you go. Now, one thing I do want to point out here is I like to see the distribution of market conditions with respect to who's buying. So first-time home buyers accounted for 32% of the homes, which is up from 29% a year ago. Sales to investors, 17%, up from 16% from the previous year. Cash sales were down to 21%, down from 23% from the year before. And distressed sales were only 2%, down from 4% the year before. I look at distressed sales as, January, everybody, hits the marketplace with, New Year's resolutions and wanting to do deals, et cetera, et cetera. So I believe that, just, excuse me, having less distressed sales is a factor of less inventory and some other reasons that we'll talk about in the next video here with respect to foreclosures and short sales, et cetera. So there's just less distressed sales available, or less distressed property on the market, which means less sales. And of course, these are a favorite of investors, whether they're mom, pa, small investors, or hedge fund, corporate, real estate investment trust investors as well too. So we just see a drag and less in that market segment. All right, so let's take a look at now pending home sales. Pending home sales spike in January. Will stock slump hurt the housing market? So, one of the things that, we've all been, if you follow the information, the news, and again, I don't really report on the financial aspects of the repo market, the bond market, stocks, whatever, even though I understand them and I understand how they play into it. I'm not an expert to talk about that and how it impacts housing, or at least my opinion. I don't think I want to get into that. I think it just opens up too many cans of worms and doors. But, what we find is that traditionally when stocks have a hard time, investors want to move their money into more tangible assets like real estate, and they tend to do more purchases or focus on that. So just keep that in mind. Once again, pending home sales is the tiebreaker in U.S. housing as new home sales soared and existing home sales dipped in January. Pending home sales fell 4.9% month over month in December, and were expected to rebound to 3.0% month over month in January, but accelerated more, rising 5.2%. And I guess there's a revision in December as well too. So the month over month rise is the biggest jump since October 2010. So again, January, what do people do? If the new lower rates, we run out, and if it's depending on where you're in the country, you're going to go buy a home. Why lower rates? Let's do that now. And I know a lot of articles written about getting the jump on the spring selling season, like maybe the spring selling season starting in January because it's a new year, people are motivated, and there's new lower rates. Let's jump on that right now. So this month's solid activity, the second highest month figure in over 2 years, is due to the good economic backdrop and exceptionally low mortgage rates. So once again, Lawrence Young, the chief economist for National Association of Realtors, is basically talking mortgage is increasing. Lower mortgage rates are increasing affordability, but we're still lacking in inventory. So that's the same thing, just said once again. Signings last month increased in all regions but the West, which is interesting. The index of pending sales jumped 8.7% in the South, the biggest region to the highest level since March 2006. So yes, I can tell you that I've seen a lot of sales activity happening over the past month and a bit here. So whether it's primary or investor, I see a lot more investor stuff personally, but that's what's happening. And of course, mortgage rates have collapsed in recent days, so we see possibly more demand for purchases. So there you go. Again, so that's where things are at. So we're seeing maintaining of home values. We're seeing existing home sales drop slightly, but we're seeing a little uptick in pendings, which is contract signings that'll be future closings, which would reflect in March, April, May, etc. So closings can take typically between 30 and 60 days is when we see the effect of those when they actually hit as a closed transaction. So please keep that in mind. So anyway, that's a scoop for today. I'm not going to get into any more because I'll do some more videos quickly here, but that's where we're at. Wanted to say, hey, if you're not already subscribed, please subscribe to my channel, help it grow. I really appreciate that. I see a lot of activity now from the purchase side, especially on the investor market. And I know I mentioned this before, but I've kind of got it sort of formally set up now. So one of the things I want to discuss briefly here, and please feel free to reach out to me at my email to connect, and I can send you this information. So I kind of am developing what I'm going to call a turnkey investment strategy and service. And The whole idea is that, building sort of a system and through partnerships and networking and contacts, I can support real estate investment and wealth growth for you in this area where I am in Florida. So what I've sort of set up here is funding sources if required. We can find the deals. And again, one of my fortes is not just looking on the local multiple listing service. Like, listen, anybody can do that. You can look at it on your own via the third-party application, Zillow, Realtor.com, things like that. For me, it's more off-market deals that come my way, private lists, bank-owned lists, stuff like that. Stuff you're not going to see typically on the MLS or on third-party sites. So we can locate the investments, we can evaluate the investments, we can manage your acquisition process, we've got contacts for property insurance, we can manage and give you contacts for the property rehab, we can do tenant acquisition if required, we can refer you out to property management companies and do some of that ourselves. We can also sell the property if you want to fix and flip and help you move it. We have legal and support services. What I mean by that is I've got attorneys available, we've got title companies and all the support services that are required to sort of do fix and flip, a buy and hold, whatever you want to do. So please keep that in mind. Obviously, we'll have to talk personally about what you're looking to do and see if it makes sense to work together. But I want to put that out there that I actually have something formalized now that we can move forward with. I know some people have inquired. I've got it sort of right down now. I do have some clients I'm doing this for on a daily basis. And as I said, we're seeing more and more off-market properties. I'm seeing more and more coming across my desk and more opportunities. Just got one texted to me a few minutes before this video. It looks decent. We're running the numbers on it. I'm going to see it tomorrow and see what it's all about and probably recommend that to one of my buyers. So if you want to get in on this, email me and we'll talk. Also, still lots to go with respect to training. I do believe that because of the inventory and the market and where it's at, pre-foreclosures and short sales will start to rear their head as time goes on this year, and more people will start to look at that marketplace as an untapped source of inventory. So if you want more information on how to get access to that and how to do that, how to get trained on it, and how I can help you, please drop me a line as well too. So having said that, thank you very much. I appreciate your likes, your comments. Please share the video with your family and friends. As I mentioned, please subscribe, help my channel grow. I'm going to start hitting the, again, been very busy, but try to do some more of these videos more regularly now just because I just was in a little patch of a very busy time. So again, appreciate the views and the time. We'll talk to you later on. Thank you.